Oh, hey, didn't see you there. Welcome to my channel called Investing Sucks, where we talk about the part of investing that sucks. So, I'm a young guy, and what I personally hope to achieve through investing is to build stable long-term wealth by investing in diversified index ETFs or index mutual funds and buying and holding for as long as I can. It seems pretty simple, right? But here's the problem. Right now, it seems that every asset class is currently trading at an all-time high, whether we're talking about growth stocks, value stocks, whatever type of name you want to put on stocks that fluctuate 5 to 10% every day. And even beyond that, we're looking at cryptocurrency. That was recently at an all-time high, although it's come down a bit now. And even depending where you live, real estate can be very high. If you look at specifically my area, real estate has gotten to the point where most people are priced out of the market, and affording a home is becoming really just a distant future that not a lot of people seem to be able to achieve. We're also seeing other asset prices like gold, for example, not trading at all-time highs, but certainly high historically when you look at to where they've been in the past. So then the question becomes, how do you invest in markets like these? And even should you invest in markets like these? So the first thing I want to do in this video is just kind of provide a brief explanation to what is happening. And it's a very simple explanation, and I think it's one a lot of people already know. So there's really two main catalysts for this. One is rock bottom interest rates, and what this has led to is really just a whole army of investors who are looking for yield somewhere. They're not getting the yield they used to on corporate debt or on government debt, so they're moving into equities markets. And this is because the return on such debt is just absolutely abysmal right now. I mean, it's barely even making the inflation rate, which means you're losing money in real terms. And also, when interest rates increase, bond prices decrease. This is just finance 101. And since interest rates can really only go up from here, bonds suddenly don't seem as attractive. So then people go searching to equities for better returns, or maybe they turn to cryptocurrency for better returns because recently cryptocurrencies have been getting pretty good returns. You can't deny that. You also have a lot of printing money. So this is no surprise. We've been hearing about this for a while now. A lot of people are worried that this is going to lead to inflation. And really, if you look at all these reports that have come out of 20% of all US dollars were printed in the last year. I think that's caused a lot of fear to a lot of people. And of course, there's been stimulus checks that have been given out. And because of still some COVID lockdowns that are in place and travel restrictions, a lot of people aren't using that stimulus money to invest it back in the economy and buy things and expense it to various things. Instead, they're taking it to the stock market because they've been told now is the time to build long-term wealth and you should be investing now and building towards that future. And what this leads to is asset price inflation. And this can be evidenced by the fact that if we go back to December of 2020, the average PE ratio of the S&P 500 index was just under 40. And about 2 years ago, it was just under 20. Now, I think it's also safe to assume that these higher PE ratios might be due just to the fact that in 2020, a lot of companies had decreased earnings, and a lot of investors in general are expecting these companies to make a full recovery because COVID at one point will go away. And once it does, these lockdowns that cause the company earnings to be lower won't be there anymore, and their earnings will go back to normal. So that's likely what's causing the PE ratio to be much higher now than it was 2, 3, or even 5 years ago. And it is important to keep in mind that these events are still developing. I personally look forward to the day 5 years in the future where we can look back at what's going on right now economically and in the financial markets, the economy as a whole, and kind of come up with a proper explanation for it and really put a pin on what it was that happened, and also see how inflation turns out to be, because right now that is a pretty hot topic. A lot of people are worried about inflation, which is causing a lot of ruckus in other parts of the market, such as equity sell-offs, when that report came out recently about how inflation was a lot higher in the month of April than people expected. So hopefully in 5 years we'll come to a logical explanation for what's happening and things will start to make a bit more sense. But just for the average retail investor out there who's just looking to invest their money incrementally, looking to build long-term wealth, these sky-high stock prices just don't seem to add up, especially during a time of economic recession. Except when you think about it in the context of everything that's going on in the economy, so the money printing, the very low interest rates, then these sky-high asset prices do seem to make sense. So what the challenge becomes for the average retail investor out there when asset prices are what they are is, should you invest right now? Because if you look throughout history, and this was something I did a video on previously, if you look throughout history, you see that the best time to invest is when the stock market has a major sell-off. So it's that common saying, be greedy when others are fearful, and be fearful when others are greedy. So when markets are at an all-time high, how can you really kind of convince yourself to be investing now? Because Historically, if you look at what usually happens in markets, there's usually a sell-off when asset prices reach this level. And you don't want to be investing right before there's a sell-off. You'd rather be hoarding cash right now, waiting for a major sell-off to occur, and then capitalizing on that and taking advantage of the lower stock prices. Because if your goal is to hold on to your investments as long as you can, which is really what you should be doing, then that's going to lead to much, much bigger returns way in the future. But before we decide on that as the definitive strategy, let's just go back to investing basics, right? Dollar cost averaging. What is dollar cost averaging? Well, the idea of it is you invest in increments, right? You don't invest all your money at one point. You invest in increments, so your dollar cost average of your investment is spread out over multiple investments. It's not just one lump sum investment that you invested, maybe at the peak of a market, which wouldn't be good, or at the bottom, which would be good, but it's unreasonable to assume that you can predict exactly when that's going to happen. Investing in increments over the long term is good because it allows you to average out those highs and those lows, because as we know, you can't predict when a market is going to hit its bottom. It's just unreasonable to think that you can do that. So with dollar cost averaging, you average out the highs and the lows, and overall you're going to do okay. But that one strategy you could take, and I personally wouldn't even fault you for taking it, is to hoard your cash. Wait for some sell-off to happen. If you do have a strong conviction that you feel that there's a sell-off about to happen, hoard your cash and wait for it to happen. But just to put this all into context, I came across an article recently which was talking about this one investor, and basically they referred to him as the worst investor there ever was, the worst market timer ever. So he invested at the peak of pretty much the worst times since going back to the 1970s that you could have invested. So right before the 1970s bull run, right before Black Monday, right before the dot-com crash, and then right before the 2008 financial crisis. But the key thing was he held on to all of his investments until today. And despite such abysmal timing with his investments, he's still doing very well because asset prices and the S&P 500 specifically right now, compared to where it was back even at the peaks right before all those crashes, is still much higher. And that's generally how these things work when you take a long-term approach. Is most of the time, even if you invest at a horrible time, you're still going to do okay in the long run if you just hold on to it for as long as you can. Now this relates specifically to the S&P 500. Now the NASDAQ, especially with the dot-com bubble, is a totally different story. If you had invested in, say, a NASDAQ index right at the peak of the dot-com bubble, that would have been pretty bad. It would have taken you, I believe it was about 15 years to recoup your initial investment for that. But I think it's safe to say that the NASDAQ is much more speculative than the S&P 500 is. The NASDAQ tends to have, more of those loss-making companies like your small cap tech companies, your biotech companies, companies like that. So because of all this uncertainty that there may be a potential correction in the market, I honestly just think that continuing to dollar cost average over the long term is the best thing you can do. Now maybe you will hoard a bit more cash than you normally would while investing a smaller amount in increments. That'd also be a pretty good strategy, because if you're right and there is a correction in asset prices, you have a bit more cash to capitalize on that. You'll be able to buy into all these index funds at such a low price, and if you hold them long enough, your gains over the long term will be pretty substantial. I did a video recently where I talked about the gains you would get when investing in the S&P 500 index, and this is just purely capital gains. This doesn't account for reinvesting dividends, and what it clearly showed was the best time to invest in an S&P 500 index was when the markets were in a free fall. As immoral as that may sound, the best time to invest is when there's chaos in the world. Now this is not revolutionary information. This is definitely something that most investors are aware of. So clearly there's a few different strategies that you can take here. Now me personally, I think that just straight up hoarding cash isn't the best strategy to take, because there are some potential gains that you could get in the short term, meaning the next 1, 2, 3 years, that maybe you would get as the market continues to stay how it is now. Just make sure that you stay disciplined, and when you invest with a long-term mindset, and your plan is to hold on to it for as long as you can. Don't make changes to your long-term financial goals based on information that's only relevant in the short term. So whether we're talking about tapering of QE or the raising of interest rates, if news were to come out about those items, yeah, it would probably cause a pretty big sell-off in equities markets, which would lead to some short-term losses. But those are only temporary. You don't want to make changes to your long-term financial goals based on information that's only going to be relevant in maybe the next 5 or even 10 years. Because if your goal is to invest for a 40 or 50 year time horizon, or maybe even longer than that, that information won't be relevant. So anyways, that was just some food for thought for you guys. So I hope you enjoyed this video. If you did enjoy it, then please leave a like. It would mean a lot to me. And also subscribe if you're new to this channel and you like this type of content. I do have more content like this planned. And with that in mind, I'll see you in the next one.